Welcome to Vedcus Finance. Intel has reported one of the most surprising earnings reports of the year. The chipmaker beat Wall Street expectations on revenue and earnings, expanded its AI business, and improved operational performance. Yet the company also reported a staggering $11 billion quarterly loss, sending investors scrambling to understand what really happened. In today's report, we'll break down Intel's latest quarterly results and explain why the headline numbers tell only part of the story. Intel's second quarter results presented investors with a striking contradiction. On one hand, revenue increased by more than 25% year-over-year, reflecting strong demand across several business segments. On the other hand, the company reported an $11 billion net loss, overshadowing what was otherwise a strong operational quarter. The conflicting numbers raised an important question. Is Intel's business improving, or are deeper problems emerging beneath the surface? Looking at the operating performance, Intel delivered results that exceeded analyst expectations. Quarterly revenue came in above consensus estimates, adjusted earnings per share also beat forecasts, and gross margins showed meaningful improvement compared with previous quarters. These results suggest that Intel's core business is stabilizing as the company continues executing its long-term turnaround strategy. Artificial intelligence remains one of Intel's biggest growth opportunities. The company reported that AI-related products now account for a significant portion of its overall business, supported by growing demand from enterprise customers and data centers. As global investment in artificial intelligence accelerates, Intel is increasingly positioning itself as a major supplier of AI infrastructure and advanced computing solutions. Intel also highlighted continued progress in its Foundry business. The company's strategy extends beyond designing its own processors. Intel aims to manufacture chips for other technology companies, competing directly with established contract manufacturers. Although the Foundry business requires substantial upfront investment, management believes it will become a key source of long-term revenue growth. Despite strong operational performance, the headline figure that captured investors' attention was an $11 billion quarterly loss. According to the company, the majority of this loss did not result from weak product sales or declining customer demand. Instead, it was largely driven by accounting adjustments, restructuring expenses, and one-time charges that significantly affected reported net income. Much of the reported loss was tied to accounting treatment rather than cash leaving the business. As Intel's share price moved higher, accounting rules required the company to recognize changes in the value of certain financial instruments, including convertible securities. These adjustments reduced reported earnings, but did not reflect deterioration in Intel's day-to-day operations. Intel continues investing aggressively in manufacturing capacity and advanced semiconductor technology. Building next-generation fabrication facilities requires billions of dollars in capital expenditure, but management believes these investments are essential to meet future demand for AI chips and advanced processors. The company's strategy remains focused on long-term competitiveness rather than short-term profitability. Following the earnings announcement, Intel shares came under pressure as investors reacted to the headline loss. Market participants initially focused on the large negative net income figure, even though many analysts noted that the underlying business performed better than expected. The reaction highlights how headline numbers often drive short-term market sentiment before investors fully evaluate the details. Financial experts say Intel's latest results demonstrate why investors should look beyond the headline figures. While reported net income showed a substantial loss, operational metrics, including revenue growth, margin improvement, and AI expansion, paint a much stronger picture of the company's current business performance. For long-term investors, these underlying fundamentals may prove more important than one quarter's accounting adjustments. Going forward, analysts will closely monitor three key areas. First, whether Intel can continue growing revenue in its AI business. Second, whether its Foundry strategy begins attracting additional customers. And finally, whether future quarters demonstrate sustained improvements in profitability and cash generation. These factors are expected to play a much larger role in determining Intel's long-term valuation. Intel's latest earnings report serves as an important reminder that headline numbers don't always tell the full story. Behind an $11 billion reported loss was a company that exceeded expectations on revenue, strengthened its AI business, and continued executing its long-term transformation strategy. Whether Intel can maintain this momentum remains one of the biggest questions facing the semiconductor industry in the months ahead. For more updates on global markets, technology, and investing, stay tuned to Vedcus Finance. Thank you for watching.